Hello, welcome to lecture 2 of module 12. Here we are going to make a deep dive into one of the most celebrated model of valuation of business, which is extensively used by the corporate world users so far as the ascertainment of the legitimate value of a business. Now, in discounted model, it is theoretically sound, and so far as the approach is concerned, it takes a note of all the pragmatic aspects of a business while ascertaining the value of the business. To move further, discounted cash flow model is a popular and theoretically solid approach for business valuation. By carrying the time value of money, it calculates a company's worth by estimating its anticipated future cash flows, which are then discounted to their present values using a rate that accounts for the cash flow risk. The discounted cash flow model relates the value of the firm to the present value of its expected future cash flows. It is based on the time value concept, where the value of any asset is the present value of its expected future cash flows. Now, when you are talking about the premise on which the discounted cash flow model works, we are there to see to the fact that here assets that fetches the value based on the expected cash revenue what an asset is going to generate down the line in a future span of time. So, the discounted cash flow model accommodates all the pragmatic approaches which are used in the financial literature while calculating the value of a company. Now, moving further, when you are talking about the discounted cash flow model of business valuation, there prevails n number of steps which are expected to be executed in a systematic and scientific manner. Now, to start with, when we are there to calculate the value of a company, we are there to start with the estimation of operating cash flow for the forecasted period. Here let me make a mention of the fact that here the forecasted period is normally extending to the near future of the business. Say we are standing here in 2025 and we are going to calculate the value of a company, and we are there given the information about 2025, and we are talking about the forecasted period. We are there to generate the operating income orientation of 4 to 5 or 7 years up to a maximum which is pragmatically feasible to predict. And after predicting the 4 or 5 or 7 years of near future, we are there to move further into the protocol of calculating the value of a company. So, the first step associated with discounted cash flow model is to calculate the operating cash flow related to the business for a forecasted period, which is also otherwise labeled as explicit forecasted period. Because in the discounted cash flow model, one of the fundamental assumptions is that we are taking the company or the business as a going concern. We are not going to say that the business is going to be liquidated or the business is going to be winded off. So, when we are talking about the valuation of a business based on discounted cash flow model, as we are going for projecting the operating cash flow in the near future carrying 4 or 5 or 7 year span of time, we are assuming that the business will continue to exist till perpetuity. And in this, while we are talking about the first step of projecting the operating cash flow, we are there to consider all the operating expenses which leads to flow of cash, because we all know the calculation of income based on accounting orientation also accommodates many items which are non-operating in nature or non-cash in nature. So, while projecting the operating cash flow, we are there to make necessary adjustments with regard to the non-cash or non-operating items which are more or less used while calculating the income based on accounting approach. Now, after calculating the operating cash flow, we are also there to estimate the non-operating cash flows. And why we are into the protocol of estimating the non-operating cash flows? Because it may so happen that in a particular business there prevails heavy element of idle cash, and in order to make use of those idle cash, the companies are regularly resorting to the task of investing such cash in other companies in different financial instruments. Now, when they are committing such cash in other companies, they are also generating certain return in consequence to that act of investment. That has nothing to do with the operating income of the business, but that contributes towards the cash inflow of the business on a broader orientation. So that's why we are also there to estimate the magnitude of non-operating cash flows which a company is going to generate down the line during the explicit forecasted period. After that, we are there to go for the estimation of gross investment. Now, gross investment simply represents two subcomponents. One is what is going to be the quantum of investment in fixed assets down the line in the explicit forecasted window, and what is going to be the additional investment in working capital, essentially in the current assets of the business. We are there to club both these components of investment, whether it is in fixed asset or it is in working capital, and we are there to ascertain the gross investment which is expected to be made down the line in the forecasted window period so far as the quantification of the value of the company is concerned. Here we are there to be very careful with regard to the quantum of depreciation that is going to be charged down the line in the forecasted window period so far as the fixed assets are concerned, because there prevails different methods, different approaches to the quantification of depreciation against the fixed assets. So we are there to adopt the same method during the forecasted window period for the purpose of ascertaining the value of gross investment legitimately. We are not supposed to make use of different methods in different years within the forecasted window, which is going to distort the calculation of gross investment and specifically in the fixed asset. Then there comes estimation of cost of capital. When we are talking about estimation of cost of capital, we all know that cost of capital simply means the weighted average cost of capital, and weighted average cost of capital accommodates at least 4 different sub-components of capital, starting with the cost of equity, then cost of preference share capital, then the cost of debt capital, and the cost of retained earning. And we all know that there prevails different models, different methods, different approaches to the ascertainment of cost of equity capital, to the ascertainment of cost of preference capital, to the ascertainment of cost of debt capital, to the ascertainment of cost of retained earning. But here we are there to go for the ascertainment of weighted average cost of capital, and for calculating the same we are there to make use of a composite formula. Then we are there to accumulate all these things, and we will go for the quantification of weighted average cost of capital. Then there comes the estimation of present value of free cash flow. Now, for calculating the free cash flow, we are there to offset the capital expenditure in the form of gross investment against the operating cash flow or against the total cash flow, and we are there to calculate the free cash flow at the disposal of the company, and after that we are there to make use of a proper discounting rate, and we are there to quantify the quantum of free cash flow in terms of its present value over the forecasted window period. And for that purpose, we are there to normally make use of the weighted average cost of capital as the discounting factor in order to calculate the present value of future free cash flows which are expected to be received during the forecasted window period. Then there comes the estimation of discounted continuing value of the firm. When you are going to talk about the discounted continuing value of the firm, let us first discuss the continuing value of the firm. Continuing value of the firm is simply based on the fundamental assumption that the business is going to exist for an unlimited period of time. And if the business is going to exist for an unlimited period of time, then how are you going to quantify the terminal or the continuing value? Because what we are doing, we are considering a forecasted window period and we are calculating the present value of free cash flow. But after that, what is going to be the continuing value? There prevails different approaches. We will be discussing these things in detail subsequently. Then there comes the estimation of the value of the firm, which is the last step in the discounted cash flow model. Then moving further, let us take off with greater detail the estimation of cost of capital. Just I have hinted upon while discussing the steps associated with discounted cash flow model that we are there to make use of weights, and here weights means the proportion of the particular component of capital to that of the total capital employed in the business. So here weighted average cost of capital is to be computed as the weighted average of the cost of all the sources of capital. The weights assigned are based on the market value of each of the components of the capital, which is superior to the weighted based on book value. The formula to calculate the cost of capital is as follows, that is cost of equity into the proportion of equity divided by the total capital employed plus cost of preference share capital into the proportion of preference share capital divided by the total capital employed plus cost of debt after tax into the proportion of debt upon the total capital employed. Here I am there to make a mention of the fact that classically when you are into the protocol of calculating the weighted average cost of capital, we are there to fetch the proportion of capital vis-a-vis the total capital employed from the balance sheet itself. But that is not the pragmatic approach to go for the calculation of weighted average cost of capital. It is always imperative and advisable while calculating the weighted average cost of capital, we are there to ascertain the market value of these components. Like what is the market value of equity instead of carrying the book value of equity. Because if you are going to go with the book value of equity, we are more or less demeaning the calculation of weighted average cost of capital. For that purpose, it is always advisable to go for the market value of equity rather than the book value of equity while ascertaining the cost of equity. Similarly, we are there to go for the consideration to the market value of the debt rather than carrying the book value of debt which is finding a place in the balance sheet. So, in this model or in this formula which facilitates the calculation of weighted average cost of capital, everywhere as far as possible we are there to ascertain the market value of different components of capital, and we are there to make use of the market value as the weights vis-a-vis the total capital employed, and we are there to go for the calculation of weighted average cost of capital. Moving further, where all these things have been mentioned over here, so far as K is the cost of equity capital, E is the market value of equity capital, and so on and so forth. Then how to calculate the free cash flow? Here there is a mention in this slide, the free cash flow of a firm is the sum of its free cash flow from operations and its non-operating cash flows, and the net free cash flows is calculated as follows. Net free cash flow is equal to free cash flow from operations plus free cash flow from non-operating activities minus gross investment. I already hinted about this while discussing the steps to certain extent. Now, let us go further deep into the calculation of free cash flow. Simply, free cash flow represents that cash which is made available at the disposal of the business to go for any act of expansion, to go for any act of diversification, to go for any act of penetrating into a new market or adding new product to the existing line of products and so on and so forth. And that is a proxy of the capacity and capability of a business to go for acquiring all these activities which are going to magnify the revenue generation capability of a business and which is going to be very pivotal for the growth of the business in the long run. So that's why discounted cash flow model, as it is based on free cash flow concept, here it is having an edge over the other, and the free cash flow as mentioned in the slide is calculated by accumulating both the free cash flow, the component of free cash flow emanating from the internal operation of the business under the heading of operating free cash flow generated in the business, and the non-operating cash flow generated from outside of the business as a consequence to commitment of capital in the form of investment in other businesses or in other financial instruments in the financial ecosystem. So, clubbing both the inflows of cash, we are there to offset the additional investment what the business is expected to commit in the form of fixed asset and in the form of working capital, owing to the simple reason that when we are apprehending that the sales is going to grow at a rate of 10% or 15% down the line in the explicit forecasted period, that can never be achieved without committing additional capital in the form of fixed asset or without enhancing the infrastructure associated with the business. So, obviously, when we are talking about magnification in sales in one hand, we are also there to talk about magnification in the quantum of fixed asset on the other hand. So, obviously, there is going to be some commitment of capital additionally towards fixed asset and towards the requirement of working capital. If the sales is going to grow or the revenue is going to grow, obviously the recurring activities or operating activities and its magnitude will also increase over the years by the passage of time. So, we are there to offset the gross investment in the form of fixed asset and current assets against the total cash inflow of the business, both operating and non-operating, and whatever is left is otherwise considered to be the net free cash flow at the disposal of the business. Moving further, there comes estimation of discounted continuing value. While discussing the steps, I also hinted about it. The continuing value represents the value of the free cash flows beyond the explicit forecast period. The most common method to compute the continuing value is the free cash flow method. The premise of this method is that the free cash flow will grow at a constant rate after the explicit forecast period. The continuing value may be calculated as follows by using the formula, that is continuing value in the period n is equal to free cash flow in n plus 1 period divided by the cost of capital minus the growth rate. Now, as I said, the continuing value simply implies what is going to be the present value of the free cash flows beyond the explicit forecasted window period what we are considering. Because as we are carrying the assumption that the business is going to go for unlimited span of time, or in a technical expression, we are assuming that the business is in a state of perpetuity, the business will continue to generate free cash flow even beyond the explicit forecasted period. What is going to be the value of those free cash flows over and above the explicit forecasted period, and that represents the continuing value. And when we are introducing the time value of money to calculate the present value of the continuing free cash flow beyond the explicit period, that is leading to the calculation of discounted continuing value of a business. Why it is sensitive? Because for calculating the value of a business, as per the discounted cash flow model, there prevails two components. One is the explicit forecasted period, present value free cash flow, and the other is the forecasted, the cash flow beyond the forecasted period, owing to the assumption that the business is in a state of perpetuity. So, while calculating the value of a firm, we are there to see to the fact that both the components are taken into consideration for the purpose of ascertaining the value of a business using the discounted cash flow model. And here, when you are going to talk about the K, that is the cost of capital, here we are normally referring to the weighted average cost of capital. And when you are going to talk about the growth rate, it is more or less conditional upon the conditions which are emanating from the market pervasive forces, because the growth of a business is more or less conditional upon the economy or the business ecosystem. And we are there to see to the fact that the percentage of growth rate is going to be pragmatic or legitimate, and as far as possible, we should try to estimate the growth rate in a pragmatic orientation rather than backed by the element of subjectivity, or by taking it for granted that if the business is going to grow at a rate of 10%, it will continue to grow in the same manner down the line even beyond the forecasted window period. So, if the assumption is going to go wrong, obviously the discounted continuing value, which is going to be very heavy so far as the valuation of a company is concerned, is going to end off with a distorted value of the business. So, it is to be taken care of that while calculating the discounted continuing value associated with a business under the aegis of discounted cash flow model, we have to be very careful in adopting the model. The most, as I said, the most popular model which is used to calculate the discounted continuing value is the free cash flow method, but there prevails n number of alternative methods like Gordon's growth model, and there prevails other asset based approaches. So, putting all these things together, the discounted continuing value of a business, as it is going to be a major component of the value of the firm, while ascertaining it, maximum possible care is to be taken with regard to the calculation of growth rate and with regard to the calculation of the free cash flow orientation. And here under this model, as say for example, if my explicit forecasted window or forecasted period is say 5 years from 25, I am starting off, and my last year is 2030. So, I have already estimated the free cash flow in the year 2030, and we are there to make use of that figure of 2030 in the numerator while calculating the discounted continuing value, and I am there to adjust the same with the growth rate by multiplying the respective growth rate into the numerator, and I am there to calculate the numerator by adjusting the free cash flow of the last forecasted period. That is why it is mentioned CVN is equal to FCF n plus 1. FCF n plus 1 simply represents 1 year ahead of the last forecasted period. So, CVN is calculated using this particular formula. Then there comes different nomenclatures which are used in this formula. CVN is the continuing value of the firm at the end of year n, that n is unlimited, and the firm at the end of the year n, FCF n plus 1 is the expected free cash flow for the year n plus 1, K is the weighted average cost of capital, G is the expected perpetual growth rate of the free cash flow. Then coming to the last orientation with regard to discounted cash flow model, as I said, it is the most extensively adopted model of calculating the value of a company, considering the time value, considering the free cash flow, and considering all those pragmatic aspects which are going to have a bearing on the value of the business on a holistic orientation. And to end off with this particular lecture, compared to other valuation models, as I said in the previous lecture, there prevails asset based valuation model, there prevails value added valuation models, there prevail hybrid models, there prevails abnormal earning models, but this discounted cash flow model is having an edge in all the facets of finance over the other models, and that is why it is one of the celebrated and most extensively used model while we are into the protocol of quantifying the value of a business backed by varied objectives. Thank you. Thanks a lot for your attention.